Why is the capitalization rate key for farm valuation? Imagine trying to figure out how much a piece of farmland is worth just by looking at its income. It might seem tricky at first, but there's a simple tool that makes it easier. That tool is called the capitalization rate. It might sound complicated, but it's really just a way to connect how much money a farm makes to what it's worth. The capitalization rate, or cap rate, is a percentage that shows the relationship between a farm's annual income and its current market value. The income used is called net operating income. This is the money left after paying all operating expenses like taxes, insurance, and management fees. To find the cap rate, you divide the net operating income by the farm's market value. The answer is a percentage that tells you how much return the farm gives based on its price. Farm cap rates usually fall between 2% and 6%. If the cap rate is low, it means the land is worth more compared to the income it produces. If it's high, the land might be cheaper or seen as riskier. This range is typical because farmland usually doesn't generate huge annual cash flow, but it has the potential to grow in value over time. The cap rate is important because it helps investors compare different farmland options fairly. It's like a common language for valuing land based on income. If you know the net operating income, you can estimate how much the farm is worth by dividing that income by the cap rate. For example, if a farm makes $300 per acre each year and the cap rate is 3%, the land's value is about $10,000 per acre. If the cap rate increases to 4%, the same income would support a value of about $7,500 per acre. This makes the cap rate a handy tool for buying or selling farmland. It shows how much income the land can produce and what that means for its value. But it's not perfect. Farm income can change a lot because of weather, crop prices, or tenant decisions. That can make it harder to relying solely on income for valuation. Farmers often look at recent sales of similar land, which can sometimes clash with income-based estimates. For farmland investors, the cap rate is more than just a number. It's a way to see the risk and potential return of an investment. As more professional investors get involved in agricultural real estate, using the cap rate is becoming more common. It helps treat farmland like an income-producing asset, similar to other types of real estate. In the end, the cap rate is key for farm valuation because it links how much money a farm makes to what it's worth. It helps compare different options, estimate value when sales data is limited, and understand market trends. While it needs to be used carefully, especially with income fluctuations, it remains one of the most practical tools for anyone serious about farmland investment.